Perfect. Boyd, can you hear me? Can you see me?
Both.
All right. Perfect. Well, it is 10 a.m. sharp. Let's get rocking and rolling with our quarter 2 market report. Super pumped. I know we have many trickling on. I think we had what 130-ish register for this, Boyd. Well, let's get rocking and rolling. As always, appreciate you for jumping on. This is our quarterly market report where we go over all things when it comes to data. I think we're up to 100 and something slides on this. As always, big shout out to Gordon on putting all this together. He spends countless hours on the slides, on the data and sourcing, the accuracy of where we pull some of the data. So thank you, Gordon, for that. As always, kwutah.com, click on resources, agent resources, quarterly market report. You rock stars out there are welcome to use any and all of these in any presentation, buyer consultations, listing consultations. We do this for you to give you some value information on helping your clients. And we also record this, kwutah.tv. There links to our YouTube channel. So I want to introduce myself real quick. My name is Johnny Christensen. I am the Utah Regional Director. Been with Keller Williams since 2007. Seen a few shifts in my days as well. But we have a special guest flown in from Jamaica. Just kidding. Boyd Brown, our very own Boyd Brown. Total rock star, one of my favorite mentors out there. He is the operating partner of KW Utah Realtors. KW Salt Lake City helped put together the group and launch as operating partner the South Valley office as well as the OP, the Westfield office. He was my boss back in the day. So shout out to Boyd. And after all that, he's even better at land, all things land development, land sales. Built a career crushing that. So he's got a bunch of major developments going on. He's a Dallas Cowboys fan, Yankees fan, and he's a gentleman. Boyd, welcome to the show today.
Thank you. And one of our former team leaders, Shauna Thomas, used to refer to that we would have new agents on our rosters and slightly used agents. And I'm definitely more in the slightly used agent at this point because I've been licensed since 1995. So glad to be part of this and watching the growth and seeing our industry and certainly Keller Williams and the market change over that time.
So your 30-year anniversary is coming quick. We better celebrate that.
Yeah.
Well, I was thinking about you, Boyd, this morning, and there's just two things that I think I've learned from you over the last 15 years that relate to the market and just watching the real estate market. Number one is I think you've helped me really understand just the macro trends. You know, what is the total economy? What is the big demographic moves in the country? As long as you're kind of paying attention to that, for the most part, you can really make sure that you're lowering the risk as you jump into real estate investing. And then the other thing I was thinking about you, Boyd, is you've been very great on just being calm in any sort of storm that I feel like I've faced or we faced. When things happen, whether they're shocking or they're in the news, you've always just handled everything pretty steady on a day-to-day, week-to-week, month-to-month basis. So I know when we go over these stats, there's going to be some crazy things that have gone on the last year and a half for sure, but you've always handled those really well. So, well, I'll run through all the slides. Boyd, you're totally welcome to jump in. And then if both of us are stumped on something, we'll ask Gordon, who puts all this together for us. So let's look at NAR, UAR membership. As you can kind of see, I think we were under the impression that we've lost more agents than we have, but you can see UAR right now, 1.52 million realtors still out there in the country. The peak for them was 2022, 1.58 million. But look at Utah, the orange line, we were at 19,641 in 2022. We started dipping a little bit last year, but we've already kind of gone back up to 19,859. So we are at all-time highs right now of UAR membership. And if you look at kind of year by year, what's actually happened, NAR right now is down 2.31%. And then UAR is down 1.61% from June to June last year. So slight decrease, which was a little shocking when I re-looked at that. The weird thing is just our attrition. The people getting out of the industry has gone up, but then we are replacing them with new people getting in the industry at an accelerated rate too. So That's kind of what's going on as far as population goes. But here is, you know, really where I think a lot of our agents have felt this is that the sides per agent officially down to 3.8 sides per agent here in UAR, and then 5.1 sides per agent in NAR.
Johnny, just one thing on that. I'm surprised, like you are, that the decrease in the number of NAR and UAR isn't greater, based on the last 18 months that we've had reduced production. And something I heard recently that speaks to what you're talking about, the attrition and people coming in, is there are 500,000 people in real estate school studying to get their real estate license right now. So even though all the headwinds we have, our industry is always, it's fairly low barrier to entry, and it still is seen as very exciting and a good opportunity for people, to the extent that, I mean, there are always people looking to get into our industry. So even though the numbers have stayed the same, I think there has been a lot of transition where some of the older agents, more seasoned agents may have transitioned out, and we've got a lot of new people on our rosters.
Yeah, and the thing I've been saying the last couple of months is that I'm really impressed with the new agents getting into the business. I feel like they're really getting in with the desire to work and the ambition to learn all they can. You know, I think even the conditions they're getting in under, getting their license under is a good environment to learn the proper skill set to build a career on. Our 10 years from now, our top teams and rainmakers will be the agents that got in right now for sure under this market. So let's look at total market value, market volume. So again, we're going to jump back from the United States stat and jump to the Utah to compare it. Sometimes we're, you know, at the same level, but there's been a couple of surprising ones this last quarter that the United States have actually outpaced Utah a little bit, but then Utah has crushed, you know, the United States in a bunch of different things. But here is the volume, total market volume. You can see is, you know, back in 2022, agent count was at 1.58 million, but we were at 2.53 trillion dollars of market volume. You can see 23 was that big drop down to 2 trillion. And then, you know, projections are that we're going to be surpass 23 numbers, somewhere around that 2.24 trillion number. But I really like this. I was just talking to Gordon about this. This is now inflation adjusted. So we go back in time and put inflation into the numbers. So when we compare this year to 2005, 2006, in today's dollars, it gives us a little bit better perspective on how we've paced on volume throughout the year. So inflation, you can see 2022, we were actually 2.65 trillion volume. Which 3.15 in 2021, which was our record, takes us all the way back to 2005 at that 2.9. But you can see 2023, we shrunk down to the 2.09, and then projections 2.24. So they're still projecting a lot of the data on us finishing this year with a better volume, especially with prices still having trickled up a little bit, has helped that. But you can see where we're pacing on that. 2021 was just such an outlier. That was a crazy year, no doubt, Boyd, for us. So here is Utah snapshot. So this is kind of just total, you know, summary of kind of what we're going to cover. I always like to pay attention just to the right side of this. You can see year-to-date 2023 and then year-to-date 2024. So it's comparing where we were last year with this year. New listings, 12.4% up. So there's been 12.4% more new listings that have come on the market. Hopefully you agents are having more seller appointments. You're getting those listings signed because there's a little bit more out there in the marketplace. Pending sales, which is under contract, slightly up 3.6%. We're currently at 21,730. And then closed sales, again, we took that big drop 2022, even 2023, but we're starting to recapture a little bit of that, but we're up 2.3%, officially at that 20,270 closed sales number. Days on market, surprising, across the whole state, we are flatlined 56 to 56, and then median sales price up 4.1%. Boyd and I were having a conversation yesterday. Again, one of the underlying issues is a supply challenge. We need a little bit more supply, no doubt, which is probably fueling, even with rates where they're at, that increase in median sales price, almost at that 500,000 even number. And then percent of original list price, whatever you list it at, what it ends up selling for percentage base. So we're at 97.3% year to date, which is slightly up 1.1. So all the sellers out there are getting a little closer to what they listed at. There's a couple variables on that, but number one, there could even just be a little bit more reasonable set listing prices this year, and then what it sells for is closer to that list price that could be helping that. And then affordability statewide down 5.1%. We all know and are aware of the affordability challenges we've been going through, but with prices going up, mortgage rates kind of flatlining a little bit the last several months, you can see why we've trickled down on affordability. Average homes for sale, 61,238. So there's just a little bit more inventory out there, getting us back to that balanced market, which we should be enjoying, but up 6.6% average homes for sale. And the month supply of inventory, 3.1, up 7.6 months supply of inventory. Before we dive into all these, any comments on this, Boyd? Kind of the overall summary?
Yeah, one of the things that jumps out at me is when I was a newbie in real estate and looking into investing is I read a bunch of books and they projected that the historical average for appreciation in real estate is around 4%. And that there will be years that's higher than that and lower than that. And I've always just tried to take a long-term perspective on that. And so in our perspective as agents, the last 2 years has been really horrible. It's like we were going 100 miles an hour in a Tesla and we're now going 60 miles an hour. So the market feels like it's slowed down. And certainly the Fed with the increased rates are doing everything they can to tamp down inflation. But even with that, this year we're expected to be about at the national average for appreciation. So with all the best efforts, the real estate continues to be very resilient investment. And if your clients bought a home last year, they've already appreciated 4 or 5%. Last year was sort of the bottoming out of that, and we still had 2% appreciation. So again, it's a matter of perspective. I think a lot of our agents, investors, and maybe even our consumers, our clients got spoiled by double digit 13, 14, 15%, even 20% appreciation in a year. But I think if we know historically, if you stretch it out over 20 years, that's not sustainable. But if this is as bad as it ever gets, we're still pacing and appreciating in real estate asset, which just, I mean, it just jumped out at me that 4.1, even though it feels so slow today compared to where it was in the COVID years.
Yeah. Well, and the pain to our pocketbooks was just over the last, 20 years, the cost of homes, new construction, or even just what things are selling for has been consistently going up, on average of that ratio you said. But because rates trended downwards for so long, it made it feel even cheaper than it actually was in reality. So when rates went up, we just felt a jolt to our system on recognizing the full cost of how much those homes are. But let's look at, existing home sales. You can see year to date, which is the rolling 12 months. This is what I was just talking to Gordon about. Last year, 2023, we ended at about 4.1 million homes sold. You double that for sides, so it'd be about 8.2 sides if there's a buyer and seller side or agent representatives. Year to date, which is kind of the rolling 12 months, we're at 3.9. So they're projecting 4.3. So if you kind of dig into that, they must be projecting a pretty plentiful or abundant fall for us to not only get back on track, but to surpass 2023. So hopefully those are right, and we're going to have a pretty busy fall for everybody. But if you look at, where we're trending, 2024 is the red line. And then the teal blue is last year. So every month we've been trending slightly under where we were last year at this time, just a little bit. You can see that graph, but you can see the fall 4.1, 4, 4, 3.8, 3.8. The projections are that we're going to have better months this last 6 months of the year, which will be awesome. U.S. annual new homes sold. So this is new homes sold. New built, sold as a brand new home, pacing around that 660,000 homes sold that were new construction. You can see the heyday when they were selling a ton of new homes in the early 2000s, but even 2020, 2021 was great. That 35-year average is 697,000 coming online, new homes sold. So we're slightly under that benchmark. But, Boyd, we're very into the new construction market, with where everything's at with building. I don't know how that doesn't go down over the next couple of years unless there's a dramatic change in policy or rates drop or something, right? New homes sold, U.S. new homes sold in the thousand. You see just on month-to-month basis. April, good month. May, June, under performing where we were last year. And then here's Utah. So Utah is 2023 homes sold in all of Utah. So this pulls everything together. UAR is pretty a good source for us on data. Our peak was 2020. Look at those. The COVID years, 60,000, 55,000 when our agents were calling us, boy, just so stressed out because there was 30 offers on every home and everything went under contract in 7 seconds from going on the market. But we were last year 38,739. So when we talk about the market dropping 40% in closed units, bam, it's right there. And then you see 2023 Utah home sold where we were at this time last year for 6 months of the year, 19,800. In Utah, we are slightly above that. So 20,270 homes sold the first half of the year. And then if we do that and double, we clearly will be more around that 40,000, 42,000 mark. But the 20-year average, 43,000 homes sold in Utah. And a lot of the net migration, a lot of people moving in, a lot of positive things happening in Utah, which makes us a fan of Utah. But here is the month-to-month home sales. Month-to-month red is 2024. Let's jump into home prices. You can see early 2000s, this yellow line is a long-term 4% trend line that Boyd was talking about. When we were really building a lot of homes, oversupply, we ended up at 21% above that trend line. Just last year, we were a 9% above the trend line. But 2024 year to date, 402,000. The projections for U.S. home prices is kind of going to be on par for that, or maybe slightly under. So they think a lot of the appreciation that we're talking about, where we're at the 4%, was all earned the first half of the year, and then the last half will kind of just be like maybe a flat line is what their guess is. And then you see month by month home prices in the thousands. You can see January felt like kind of the bottom after we retracted on U.S. home prices the last half of last year. But we went from 379 to 385, 394, 408, 419 to 427 last full month, June. And then, if we do flatline a little bit, that's where we'll kind of stall at that 4 or 5%. And then here's the hard part, right? We've just seen that median home payment with rates going up. This is the median home payment, principal and interest. If you put 20% down, no taxes, no insurance, no mortgage insurance. Right now, end of June 2024, that median home payment across the country is $2,254, which even just 3 years ago, it was half that, right? You've probably heard that a lot. But let's look at Utah pricing. Again, 27% above the trend line. We've tried to remake this trend line to copy when it started with the country, which we were, very under the market, 20 something years ago. And we not only have paced, but we outpaced the growth or appreciation of the United States. So if we had that same trend line, we are pretty substantially above that trend line from where we started. But right now, year to date, 500,000 median home price in the state of Utah, which is up, from last year where we ended at 484. And then here's a month-to-month similar, not January, but December, we kind of bottomed out at that 474. And then we went 485, 490, 494, 500, 510, 505. So almost the first 5 months, every month went up 5,000 appreciation on the median home. But last month was the first month we went back down a little bit by 5,000. And then here's, where you hear this all the time with your buyers getting pre-approved for mortgages, median home payment, principal and interest of 20% down in the state of Utah, $2,666. So definitely almost double again from 3 years ago. So here's your comparison. Utah's the blue line, United States is the purple line. So we were just hugging that, United States line for so long. And then the last part of the 2000 teens started separating, but we're a whole 100,000 gap now, more expensive than the rest of the country's median price. And then here's kind of, especially you having a career for, almost 30 years, Boyd, you've seen some of these shifts, which you saw you probably heard about the savings loan crisis, before you got in, but then you kind of rode that up for a while. We had the housing bubble happen, 2005, September was kind of the peak in the country. And then that Great Recession that we bottomed out February 2009, kind of felt like it fell off a cliff back then. And then we kind of zipped back up for a couple years. COVID was just weird and unreal of what happened to the real estate market. We dropped quite a bit, then we've been recovering. But then the Fed started raising their rates, primarily May 2023. So any comments on this, Boyd, as you've seen a few shifts in your days?
No, I had a coach and mentor, a guy named John Alexandrov for years who helped me with my mindset around my career. And he just kept saying, this too will pass. And he would help me get a perspective of more long term. And almost every time, whatever market we were in, most of the realtors would be looking backwards, longing for the market we just left. And expecting that it would come back, as opposed to just embracing the market we have right now. And it took me a long time to get that message from him. But when I look at this to go back 30 years, I mean, it all just seemed like real estate. So there were ups and downs, and none of even when we talk about the great real estate recession or the bottom out at 09, I mean, now looking backwards, as dramatic as that was, it seemed like a relatively short blip of time. And then we were back doing business in a whole different market. So that's, again, I think where we're at is a short moment in time. And if you can learn to really think about your real estate career in terms of a 20-year or 10-year investment of your time and energy, this really is a short season that we're in, reacting to these interest rates.
Yeah. Yeah. And I think the number one misconception I hear about inflation, I hear people say, I can't wait for prices to go down. I can't wait for prices to go down in whatever product category they're talking about. But when we talk about inflation getting back to 2%, that's not prices going back. Like things are not going to be cheaper typically than what they were a year ago. We're just trying to slow the rate of rising prices to 2%. So the funny thing about this is just it is kind of weird how little or how few times we've actually depreciated as a housing market over the last, 70, 80 years. You saw a little bit in that savings loan crisis, but really the Great Recession's the only time that we've actually homes were cheaper than they were a year ago or 2 years ago was that Great Recession due to that oversupply, inventory that just kind of drove prices down. A lot of foreclosures, participated in that. But here's the number that a lot of people use in their buyer-seller consultations just on what values of homes have done the last couple of years. This is U.S. home prices. This is annual appreciation. The 34-year average of homes appreciating, like Boyd mentioned, is that 4% number. So 4.44% appreciation in the country over the last 34 years. 2023, you saw the country overall that year only went up 0.7%. So we didn't actually over the whole year go backwards in values. But then 2024 year to date, we kind of popped up to 5.2% that first 6 months of this year with some of the lack of inventory, people getting a little bit more used to the rates. But they're projecting just as we kind of balance out the year, we're going to only have appreciated 2.2%, which kind of off the cuff, that feels a little low to me, but I don't know how we're going to retract, 2-3%. But I think even 2 to 4% appreciation might be a fair guide. Whereas Utah, we kind of follow the country, but we've been a little bit more volatile the last 10 years. It's just so many people have moved in and we're just growing and we've got a strong economy. We for sure have out appreciated the United States here in Utah. Anybody that's owned a home knows what we're talking about. But look at 2021, 25.7% appreciation. You own a $400,000 home, it went up $100,000 of value. Those are the days that people would have condos under contract. By the time they got built and actually moved in, they had 100,000 equity. It was a crazy time frame for everybody, 13.3% 2022. But because we shot up so much, we did kind of have to retract some of that appreciation. So overall, we went down in value 5.1% last year. Already this year, we are pacing 4.1% appreciation in the state of Utah. Inventory.
I think, Johnny, that is helping us keep our market alive. I mean, there are first-time home buyers that bought these townhomes or condos or attached properties in, 3 or 4 or 5 years ago now they have $100,000 or $125,000 or more in equity, and they're using that to put down on the next home. And it just, I mean, in no point in my real estate career up to this point was I ever used to seeing people in their 20s buying their second home and bringing in, $150,000 equity. There's some real advantages to that buildup because it does help them move up market quite a bit. And also that whole wave of baby boomers that are sitting in their houses. I mean, they're oversized, and at some point they're going to shift out of these large houses. But just think about either your parents or grandparents, but the group that's in their 60s, how much their home is appreciated if they've paid the thing off and are retired and just living in it over the last 5 years. It's pretty much doubled in value. And that asset value will either go into the economy that they'll use to support themselves, or in many times when they pass, it'll be cash put back through their heirs, likely into real estate, tax-free.
Yeah. Well, and the one thing I compare from the Great Recession to what's happened the last 18 months is the Great Recession, when we were dropping so fast in units sold, the price of things were dropping just as fast, so we were in an oversupply scenario back then, but here we are in an undersupply scenario. So as units have dropped, we've held strong and even gone up a little bit on the value of homes, but it just felt like so much worse in the Great Recession because the price was not holding on. It was just tanking. It felt like doomsday there for several months in the Great Recession. So here's U.S. inventory. Let's switch to that. This is number of homes on the market. Year to date, we're at 3.4, up a little bit from 3.1 last year. Again, that dashed line, the yellow line balanced. We've always said that for a long time. The balanced market is 6 months. So we're still ways away from that 6-month mark. But even going from 1 month of inventory to 3 months of inventory, in the market has just felt so much better. I think this is really where we give a better lifestyle, I guess, for agents. When we were so low, when we got down in the ones of inventory, it was really hard on our agent base to move as fast as that market was. Here's month to month. We have trickled up. Even last month, June, we went up to 3.8 months of inventory on a month-to-month basis. And then here is U.S. pending home sales index. So anything above 100 index, that means under contracts are expanding. There's more of them. If it's below that, that means the market has been contracting, which we clearly know with units dropping. But 74.3 is where we're at year to date, just slightly behind where we were at this point last year. And here's a month-to-month basis, either at or just slightly under 2023 U.S. pending home sale index numbers. And then here is the new single family homes completed. So this is new family single housing units completed. Oops. Wait for it. There we go. That trend line, 54-year average is 12.3. 12.3, which is what, 1.2 million? We've been at 10.2, so just right around 1 million single family housing units completed. And I think what this doesn't show again is what the next year could look like with some of the challenge. A lot of these homes were started or starting to get developed 1-2 years ago. So kind of what's coming online, whether it's built for rent or built for sell, it still feels like we're doing okay, but I'm a little worried about 12 months from now as we're watching, builder permits pulled, some of the construction costs haven't really moved very much. Here's month by month in the thousands. So June outpaced, May outpaced, April outpaced.
And Johnny, that's one of the reasons why we're not seeing price decreases, because we've underbuilt for over a decade.
Mm-hmm. Yep. Yeah, and you've got that chart of how many homes we're projected to be short right now, which is fascinating. We still could absorb another 30,000+ homes right now in the market. Okay, so here's Utah, increase in Utah housing units versus increase in Utah households. I love this one. So the yellow is increase in housing units. So 2023 is 22,000 housing units came on the market. Housing increase in households is total households that we've grown. So that could either be by us multiplying and replenishing the state of Utah, or it's positive net migration. So we have more people moving in than moving out. So that this is pacing and tracking our cumulative shortage in homes for those households. So 2023, we are, they still update things, even though we've passed the time. They always go back and update a lot of these stats, which is probably one of the most tedious things for Gordon to make sure these are accurate, is the updates they make on the previous stats. But we were 33,000 cumulative shortage at the end of 2023. The forecast for this year, because we're moving in the wrong direction of that versus moving in the right direction, we might end at 37,000 homes short. That if we had those, we could totally put those to use and fill those gaps, right?
Johnny, one of the things that I mean, this is Gordon was making the point. I mean, even with the shortage and all the energy on trying to increase inventory, we just haven't been able to get more new houses out of the ground, even to keep up with it. And I'm seeing that on the land side. And the last 5 years, we've had new builders entering our market, some on the national scale. Now we have almost all the big national builders, the top 5 publics are in Utah, and they never were before. But we get a new semi-regional or regional builder coming to this market, seeing these numbers and saying, you know, if they're operating in Georgia or Texas or Florida or Colorado, they see these numbers and they're like, there is a shortage of houses. There's a long runway for us to build houses and sell them in Utah. And it's, I mean, we have such a great market, but I worry, like Gordon does, that we're just not catching up with the inventory. And if we get what everyone's asking for, is that interest rates drop 1.5 points, we're right back where we were, just burning through the inventory, and probably go from the 50 days on market back down to 10, which is a very uncomfortable market for all of us.
Yeah. Yeah, and the
So
secret
support your local land developer and builder.
Yeah, and the secret how cool and great our economy is, here in the state of Utah, the secret's been out for, several years, but there's just something about when COVID hit and after COVID that just the spotlight has been on us at a lot higher pace, which is fueling some of those big companies to come into Utah. But here is even projecting beyond this year, next year. This is all the way from 2021 to 2030, projected housing demand by county, which is great. So you see Utah County, which we have a lot of land to develop in comparison with Salt Lake. I think there's still 250,000 acres left to develop in Utah, where there's 70,000 acres left to develop in Salt Lake County. So clearly a lot of that population growth is shifting to Utah County, but new units needed 66,000 in Utah County over the next another 7 years to get to 2030. Salt Lake, 63,000, 129, almost 130,000 new units needed the next 7 years in these two counties. Units built, you can see Utah County was underpacing, but even if we could just do what we did the last decade, we'd solve the Salt Lake one, but we're underpacing that right now. Even Box Elder, right? 3,954. So if you want to start a builder in Box Elder, there you go. Here is U.S. showing index. We do have a lot of index-based stats, which is kind of taking an average number, setting the benchmark at that average number. But U.S. showing index is a higher number, means an average home receives more buyer visits in a given month. All index values are scales relative to the initial index at 100 for January 2014. So that's when they kind of put that number. We have been shrinking on home showings since towards pretty much when rates went up, right? When they started going up, but we peaked at 197. Maybe May-ish last year. And then you see the 200s being early 2023, but even just those COVID, 2021 was crazy, 230, 283, 285, 254, just a lot of showings. Here's annual months of for Utah. So let's look at a lot of that same data for the state of Utah. Kind of flatlined on annual months of inventory on average from last year to averaging out this year, 3.1 months of inventory. Here is month by month, same thing. June kind of popped, maybe a little extra inventory. Maybe we had some deals falling out in June, but 3.7 months of inventory, outpacing last year. But even just starting the year out, January, February, 2.8, 2.8. Here is new listings on the market. So 2023, we had 51,000 total listings come on the market. That 13-year average is 63.7 thousand. Had a lot of listings on the late teens come in, which upped that average. But 51,000 last year, halfway through the year last year, we were at 27,000 listings on the market. We are 3,400 listings more that have come on the year, the first half of this year. So we're at 30,525. Hopefully you're getting your fair share of listings. Here's month by month. That month of April really put us ahead of pace. A little bit of May, June flatlined. And then here is percent of new residential listings sold. This is WFR, UtahRealEstate.com only. But the blue is new listings, orange is sold listings, and then that purple line is percent of new residential listings sold. So again, we are right at 70, basically 75% of all listings that go on the market end up selling, which we peaked at 90%. That was just so crazy. You put it on the market, it was going to sell unless you were the worst listing on the market. But even back recession days, we got down to the 20-something% number back then. Only 1 out of 4 homes would sell, which was crazy. So still very healthy, especially our skilled listing agents getting more skilled on helping our sellers price it right, which has helped that trickle up a little bit, even with more listings coming on the market. Here's the month by month basis. And then here is our inventory of homes for sale. We're up about 6.6% from where we were last year. Month by month, just a little bit more homes, a lot of different ways of looking at that, a little bit more homes on the market. I always gauge it too when I log into our MLS, Boyd, is just, are we above that 10,000 active listings? Anytime I log in, are we below it? You know, we've kind of been anywhere from 7 to 11,000 the last 12 months-ish. Here's pending sales. Again, this is where we're outpacing the country a little bit. We're better than we were last year on under contracts, just slightly up 3.6%. Under contracts, which again, some of that was early in the year. We were outpacing. The last 2 months, we've been slightly underperforming. I think our agents have been using and enjoying their summers, which is great. But here's average days on market. So last year we ended at 24 days on market. We are up 16% at that 30 days on market. 12-year average, which really doesn't count that recession time period, but that's 39 days on average. So still have some room to grow. We haven't been above that trend line since 2016. But if you look at month to month, we are trending down. So if you look at US days on market, we were peaked at 38, but the whole last 5 months, we've been going down. Last month was 22 days on market, getting really low again in the United States. But average days on market, which this does include the under contract period here in Utah, but we have trickled slightly up. So 54 to 56 days. But if you take out the average under contract period, we're probably still below the country on days on market, which we've been that way for a long time. But same thing, since February, we've been trending down on days on market. So things are selling faster. Could be a little bit of seasonality, but also just shows the lack of inventory. So mortgage rates, Boyd, here from 72 to 2023, historical 50-year average, 7.74. We've heard a lot of that. But even the last 30 years, our average has been 5.98. So our 30-year average, because we had such low rates forever, we're above that 30-year average. 6.81 right now is what we've averaged for the year of mortgage rates. And projections, I hear there could be a Fed rate possibility cut at the end of the year, which is why they're projecting rates to be at 6.5. Even my lender texted our group this morning, right at 6.5 today even. So here's your annual average 30-year fixed rate mortgage. Pretty much flatline, kind of where we were last year, right? But as you can see, here's month by month with the line graph. Boyd, what's your home mortgage interest rate?
I got below 3% on a 15. I didn't get the lowest, but we did take advantage and were able to refinance at a time. I think one of our agents encouraged me because he got like a 2 1/4 on a 15 and was telling me what a buffoon I was to be sitting at 3 7, 3 3/4 or something like that. But we're planning on staying for a while, and I think that's a lot of the market is locked into these good rates. I will say though, it's amazing how much the consumers and the general public are interested in interest rates. And if we can flip that a little bit to become a conversation point for us to engage them in the real estate question, but I mean, it is so publicized and everybody's has been talking about interest rates. And I think instead of us being panicked or scared about it, use it as an opportunity to engage in the conversation. And the two positive selling points is they're probably 3/4 to almost a point lower than they were a year ago, where we're quoting in the sixes again. And they are, as Johnny is showing you, they're at or below the 20-year average from the last 20 years. So yes, it's a big jump from where it was 3 or 4 years ago, but I don't, I think the illusion that we're going back to 3% anytime soon is out of everybody's mind now. So we can have a more positive discussion about it.
Yeah. And we were talking yesterday, even you lock in at a 5, 6, 7%, like that feels, expensive compared to those low rate time period that we had. But when you lock in at a 30-year fixed rate mortgage and you actually play inflation into that because your payment's going to be the same for 30 years, it's one of the biggest assets ever to have a 30-year fixed rate mortgage. We were complaining about just all of our commercial buildings that we own that they are 5, 7-year adjustable rates. There's no such thing as a 30-year fixed rate mortgage for an office building that we own, right? So 30-year fixed rate mortgages are just very unique to the United States, no doubt. So 30-year, 15-year, you can see just kind of the gap. Sometimes those are closer, sometimes they're farther apart. Usually you're around 75 basis points, 0.75 on a loan difference. But just like you were talking about the good rate days, 89% of all mortgages in the United States have rates of 5% or less. 32% were 3% or less, which is outrageous. 3 to 3.5, 27%. You can see 3.5 to 4, 4 to 4.5, but then you even see only 5 to 6% of homes are above that 7%. So we talk about rates. So you can see that purple line, which is the Fed funds rate. That does have a major impact, but it's not always like percent by percent, of what mortgage rates do. But you can see what the Fed has been doing on the rate. So I think it's 2:30 p.m. today. The Federal Reserve Chairman will have their, weekly update, kind of just talking about the economy. Me and Gordon like to watch that. I do encourage people to watch that because by the time he says one word, the news media puts out 10 other random words that he didn't say. So just like go to the source. It's good to hear from him versus reading TMZ, what the interpretation was. But it no doubt has gone up, right? So right around that time period, we started raising the rate, but even just how flat we've been since, June-ish last year. So 5.33% is where the Fed funds rate is sitting right now. And what we always talk about is that other lever that the Federal Reserve has to pull, which is the amount of assets they own. So mortgage-backed securities held outright by the Federal Reserve, which they started purchasing in 2009, kind of coming out of that financial crisis we were in. At the peak, they were at $2.7 trillion of mortgage-backed securities that the Federal Reserve had purchased. So basically, the mortgage companies go issue loans, they package those up to securities, and then the Federal Reserve buys them to free up capital and credit for that bank to then continue to issue more loans. So over the last, same time period that they started raising the rates, they not only raised the Fed funds rate, but they've been decreasing their balance sheet on mortgage-backed securities. So basically, they've been selling those on the open market. And what Gordon and I were just talking about is they're trying to free up some of their assets. They might just have a giant balance sheet right now because if they've moved almost $400 billion off of their balance sheet, mortgage-backed securities, just so they might have extra room. So when they want to get the market even moving a little bit more, they can go buy more of those to free up mortgage companies and banks, cash to go issue more loans. So something to pay attention to. And then total Federal Reserve assets, that is mortgage-backed securities, and then a lot of other things that they own. At the peak, $8.9 trillion that they had, they're now down to $7.2 trillion. So they freed up about $1.7 trillion, basically, of Federal Reserve assets held. Who knows? Maybe it's sitting in Bitcoin, gold. I don't know. Annual Mortgage Bankers Association Purchase Index. So this is all of our mortgage friends out there kind of showing how many mortgage applications for the purchase of single-family homes are coming in. The index is set at 100, basically back to, the early 90s time period. It covers entire market. So this is government, conventional loans, and all products. 145.2 is where we're sitting at that index right now. You can see 287, 281, 258 right there. Was the heyday of the last decade, but it's just crazy what was happening in that pre-recession when a lot of those mortgage. I heard you could just get a postcard, sign the postcard, and that meant you got a mortgage back in 2003. I don't know, but 472 on that index back then, which there's probably some faulty loans that were issued back then. The weekly MBA purchase index. So here's just weekly. You can kind of see we've just been hovering around those 140s for the entire last 2 years. And then here is mortgage credit availability. So this is what's affecting different things, but this is how much mortgage credit is out there. Index right there at 100. So we've gone backwards a little bit on mortgage credit availability. So as the Fed maybe has got some of those mortgage-backed securities off their balance sheet, that's tightened up the amount of capital that banks have to go lend. So that's also maybe where they're tightening up credit restrictions, borrower qualifications, that type of thing. So down 5.49, down 14%. And the month-to-month basis, very similar to where we were last year. And then here's the refinance side of the business. So this is the mortgage refinance index, covers all mortgage applications to refinance an existing mortgage. It's the best overall gauge of mortgage refinancing availability activity. The refinance index includes conventional and government refinances, regardless of product, ARMs or fixed rates, coupon refinance into or out of. Right there at 470. So we're slightly up on refinances. I think rates got a little bit better. So I think our mortgage friends have seen a few more refinances, for sure not as many as they want, but still out there. Mortgage refinance with the 30-year fixed rate mortgage overlap. You can see that just as soon as rates start going up, refinances disappeared. We kind of all know that. This was slightly surprising to me because I know we love our credit cards. Credit cards debt's been going up. Discretionary savings has kind of been going down. But Q2 officially, we are down on U.S. properties with foreclosure filings. So a total of 89,000 U.S. properties had a foreclosure filing during Q2 of this year, down 6% from the previous quarter and down 8% from a year ago. In contrast to the first half of 2023, foreclosure activity in the United States experienced a decline in the first half of 2024. In addition, U.S. foreclosure starts also decreased by 3% in the first 6 months of 2024. So even just a lot of our sellers or our homeowners having equity has prevented, some of the challenges we were in a recession ago. But the fact that we went down was slightly surprising to me with kind of the current environment. But still very low, but we're going to continue to monitor this. This is a good one. As soon as you start seeing foreclosure activity go up, that is a potential variable that you could see a depreciation of home values coming. So luckily we've got record lows on those filings. And then here's the problem, Boyd. We even talk about our kids. What will it look like for our kids to be able to purchase homes later in life? But the U.S. affordability, the yearly housing affordability index indicates relatively more affordability. A ratio of 100 indicates that median family income is just sufficient to purchase the medium priced home. So we are at 99.9 on that index. It might not even feel like that, but slightly above on the affordability ratio than we were last year on average, but still down and still the lowest it's been since rates have gone up, prices have gone up since, this chart shows at 25 years. So 2012 was the peak of affordability, 203 on the index. And then here's a month-to-month look. So we're slightly, lower each month than we were last year nominally, but 99 on the index. And then Utah, look at Utah. So yearly housing affordability index, higher HAI ratio indicates relatively more affordability. So we're still pretty below that 100 index line the last 3 years. 2022, we got the lowest 69, 71, and we're up slightly. So this is a little good news, but not enough to make us feel better. But 74 on the index, And I'm guessing that is because prices have gone up a little bit, but mortgage rates have come down a little bit. I'm guessing the market's predicting a Fed rate cut that is helping rates the last month or two, but right there, 74 on the index. And then here you can see even just June where we saw those rates come down a little bit. That's where it popped up to that 74. Okay, anything on the major categories before you dive into investment properties? Boyd, any last comments on any of that?
No, if you go back to the affordability, I really think a lot about what could possibly happen to make homes cheaper in the next 10 years, and I'm just not convinced that it's not likely at all. So I really think the change in affordability is this inflationary period that we're in, where salaries, wages have got to go up to meet that housing. Which again, if you own assets, that's a better projection. But that affordability, I don't see any major drop in home values or real estate values. I think more likely it's just a slow process of everybody in Utah and the United States, getting increased in wages, which we've seen certainly over the last 2 years. And but the idea of people saying, "Oh, I'm going to wait till prices go down," I still hear that once in a while, and there's no part of me that can convince myself when I look at this and the shortage of housing starts and the cost of lumber and labor. I just can't convince myself that we can produce houses that significantly cheaper 5 years from today than we are today.
Yeah. Yeah, I agree. I think the market in general thinks rates will be, lower next year than they are right now. Even we met with a major construction company that builds a lot of new homes. They feel like construction prices haven't really moved too much, but they're starting to get more subcontractors wanting to bid on stuff, which means that, things might be slowing down slightly for them. So you could see some competitive bids coming in that could lower a little bit of the cost. But yeah, I don't really feel like we're going to move the needle on the cost of homes. We've probably just got to stay pretty, plateaued for a little bit, get incomes up to kind of do that. You're seeing a lot of innovation in the tiny home and prefabricated manufacturing home and stuff. Like there's people trying to figure it out, but it's a complex issue with a lot of variables that affect affordability. All right, let's hit investment properties. We'll roll through a lot of these quickly. So who owns all those single family homes? You see that in the news all the time that like corporations and BlackRock are taking over the world of single family homes. Not really, so when it comes to investments out there, mom and pop investors still own 80% of the investment properties out there. So 1 in 9 single family rentals owned is considered that mom and pop category. Regional investors, which are 10 to 99 single family homes owned. You could even just be, a partner in an LLC with a couple people that might own 11 that put you in that regional investor world. But the institutional investors or the smaller national investors still 3% and 3%. So 6% of all investor owned properties are those big, companies out there. So I know you're starting to see even some more potential bills going through Congress and stuff that's trying to even limit more of that institutional investor into but right now it hasn't been a significant issue, but I think projections are they're more worried about the future than the past. But so this is interesting because I feel like rents kind of plateaued for the most part across things out there, but here is the most updated. Rental rates are the hardest data source for us to get, and they're not awesomely updated, periodically. But you can see really 2021 was the biggest rent jump year for us. And you see 2022 was, probably fairly reasonable, kind of pacing with that appreciation. But if you look at even the HUD, they set fair market rent set by HUD. So there's a lot of government assistance programs out there. 1, 2, 3, 4 bedrooms. These are the HUD rental set rates for the Federal Housing Department. So if they issue rent for some sort of thing, these are the numbers that they'll typically pay for. But if you look at even Salt Lake, the Salt Lake City average rent is where we have the most live, accurate data. You can see 2024 year to date for a 4-bedroom, 2,922 is actually what the rent is on average in Salt Lake City. So 2023 was 2,755. So in Salt Lake City, we have seen, decent rent growth, but we again are outpacing whatever the government sets for that. You can see a 3-bedroom, 2-bedroom, 1-bedroom, all outpacing last year. And I haven't felt that very much in Utah County, but it does seem like Salt Lake has had some rent growth. So Utah housing profile, this is kind of just like the summary that they give to a lot of our state legislature out there, talking about the shortage of rental homes affordable. Right now, we're sitting at 62,000 renter households with extremely low income. Right now, they're projecting there's a 43,493 home shortage of rental homes that are affordable for extremely low income renters. Average income limit for 4-person to be in that extremely low income household is 31,000. And then the annual household income needed to afford a 2-bedroom rental home at the HUD set market rent is 51,000. So just no doubt, our cost burden, lower income families still struggling to make sure that they have adequate housing. I do think that's one of the things you'll see in the legislature with the state or government. You're going to see a little bit more programs for that, low income bracket out there. But when you look at the 1- and 2-bedroom rent growth in the United States, Utah, even Salt Lake's gone up a little bit. The United States has gone down. So we're down 0.8% on the average rent in the United States, which is kind of what I feel like solid and it's actually happening. But here's kind of what's happening on a month-to-month basis. So the average rent year-over-year change. So you saw that late 2021, 2022 early. That's where we saw the biggest jump. But you can see we're now, almost backwards year-over-year in the United States. Here
Hey,
is
Gordon, what have you seen? Have you done any renewals in the last 4 or 5 months, or are you seeing rent
Yeah,
increase or-
I've actually just kept mine level and renewed at the current rate because I'm seeing some pain whenever I start seeing disconnect notices with where they're paying the rent on time, but then I get a disconnect notice for utility. That tells me that they're struggling. So I've just kind of kept mine, and I did raise most of mine during that 21 time frame. So I'm setting pretty good on mine.
Interesting. U.S. new
we
build.
felt a dip and had to decline at times last year on some of our renewals or our expectation, but everything that's come up this year, people have been so enthusiastic to stay because I think they've started looking at the market.
Yeah.
Or we've been able to bump them a little bit. And I'm like you, if we have good tenants, we don't bump it a lot, but
yeah, because the cost of a turn's $3,000, so I'm not going to get that back in a year's time.
yeah.
Yeah, you're with vacancy and just, cleaning the carpets and all that, just it's better to give them a slight discount to keep them in longer. Yeah, good strategy. So here's U.S. new build for rent. So these are things that are being built. A lot of, homes out there that are being built strictly for rent. A lot of the companies that are building their own stuff just to rent it out. We've gone backwards a little bit. You can see 2023 third quarter was the last time they published the data. So this is one of those sources that they just all of a sudden stopped. This came from the Census Bureau, I think. Gordon, and they just stopped publishing this stat at the end of third quarter. So you see third quarter, we start going backwards. Could just be a clerical thing or a priority of what they're putting out, or maybe it's dropped enough that they don't want to publish it. I don't know. But I know at least with a lot of these apartments, Boyd and I have spent a lot of time on this. I do think there's a ticking, a time bomb or a challenge coming up next year of just everything that's still coming online was approved and started 2 years ago. So I think as we start finishing all those projects, we're going to run into a pretty solid U.S. new build for rent shortage, coming down the road. Rental vacancy rates. I always say, again, when I grew up in the industry, I was putting 8 or 10% vacancy rate on all my rental analysis. For a long time, I still put 8%, but we went so far below that in the state of Utah, but we have been trickling up the last several years. Last year, we finished at 5.3% rental vacancy across the state of Utah. United States was above that at 6.5%. That balanced is 7% vacancy. So when you're running your performance on rentals for your investor clients or yourself, I think 7% still is a very good conservative number to put on your vacancies. And then here's by county. This is as of Q1 2024, rental vacancy. Salt Lake County, 5.8%. Utah County, Summit, Washington, Cache, just really low vacancy rates. Davis 6.1 and 7.2%. So it is where Davis and Weber are leading on the vacancies. That's because of that Marcus Green lives up there. I'm not sure. Just kidding. Just kidding. Annual average operating expenses per unit as of Q1 2024. Thank you for finding this cool stat. Utah County somehow has lowest operating expenses, 5,760. So it's not including mortgage payment. It's just all the other operating costs out there. 9,000 for Summit. Cache County 9,000, which was a little shocking to me. Salt Lake County 8,872. Weber 6,500, 7,000. But yeah, Utah County. All right. Anything else on investments, Boyd, before we move on to the economy?
No, just one of the things I'm hearing on the national level, a lot of the podcasts and stuff, is the impact insurance rates are having on investments. And I don't think we've been hit as hard in Utah, but some of these states that have had so many payouts on these natural catastrophes, the wildfires and the storms and so forth, and those storms just seem to be getting more and more in the fires. So naturally, with insurance companies paying out, that puts pressure, the rates are higher. So we've seen moderate increases on all of our rental properties, including our commercial, in the probably 8 to 10% range over the last 12 months. Some states like Florida, they're at like 25 to 30%. So if you think about like an apartment complex or something like that, if their taxes are going up, they're resetting their interest rate, and their insurance is it's a small piece of operating expenses, but that's probably only going to continue to go up. That is sort of a challenge that we're seeing on real estate. It hasn't hit us a ton in the single family homes yet, but it certainly is something that will be inflationary. And I think we should expect that as a larger cost as a percentage of the ownership moving forward.
One thing that I've noticed in the 3 HOAs that I own in, the insurance rate has almost doubled.
Yeah.
It's been pretty shocking just here in the Salt Lake County area.
Yeah, there's because for me, all my rentals, I'm locked in at good rates, which has been my advantage, as prices gone up, equities kind of increased. The challenges has been all this stuff you're talking about. Property taxes is something we need to pay attention. There is a lot of cities and counties around the state right now that are proposing property tax increases. And the biggest problem we have is there's not a lot of great citizens that show up to have educated opinions on that. I think we can put pressure on some of the state, local, governments just to kind of make sure they're spending that property tax money efficiently. But that's a pending thing that's going to do that. HOA fees have gone up a little bit. I think that's another potential challenge, as I've even monitored my own HOA financials as I've got those over some of the condos and townhomes we own. Reserves are starting to deplete as like expenses of the HOA, maintaining the communities have gone up. So I do think you're going to see some more HOA increases. Maybe even they're trying to, kick down the road some special assessments, on some bigger projects. Insurance, you guys are totally right on that. But when rent's kind of flatlined, your mortgage payment's fixed, but all these other costs have gone up. Even if you had a decently cash flowing property 2 years ago, it has even gotten less and less, which is what, Gordon and I have kind of analyzed on our own book of business. So, all right, U.S. economy, the United States economy, the strongest economy in the world. Yes. Let's talk about some of those categories. GDP, gross domestic product, annual year-over-year change. Every quarter, they just throw out what is the number that we've increased or decreased on our overall economy. So this is the total collection of all basically spending out there. This is products, this is service. They try to just roll all that up and say, is our economy growing or not? 2023, you can kind of see year over year change, 2.5%. It went up 1.9% in 2022, but you see when COVID happened, it dropped and then we recovered. But let's look at the annualized by quarter. So Q2 2024, officially, they put out that our economy grew by 2.8%. And again, Gordon's favorite thing is when they go back and revise numbers, they've kind of systematically keep going backwards and revising the numbers a little bit lower, a little bit lower. So when they put out Q1, it was a little bit higher when they put it out. They've since revised it. Officially, they're saying 1.4% is Q1. But again, one of the things that Gordon and I always say is this does include government spending. So when they print money or they go in debt, then to just go out and spend on the economy it could be a little false growth out there that has happened just with some of the government spending that you have to pay attention to. So 2.8, 1.4. So if you remove some of that government spending, no doubt we've been in a negative or an official definition of a recession, time period. And the two metrics they always look at is what's GDP doing as economy before they dub us a recession, or what's unemployment doing. And it's really been the job market that has just it's continued to be robust, and reports of it being robust. But U.S. unemployment history, you can kind of see as we've been throughout the decades. 2020, when COVID hit, we just lost so many jobs because everything kind of locked down. But overall, 2020, we're at 8.1%. 2023 last year, we are at 3.6%. They like to keep this number 5% or below. You can see, throughout the shifts and phases out there. But here is just the month. So 34-year average is 5.8% unemployment. 2023, we're at 3.6%, but as of this year to date, with the Q2 numbers, we have been going backwards in unemployment. So more people are unemployed, 3.6 up to 3.9 U.S. unemployment. And then when you look at monthly, if we were at 3.6 on average last year, we're up 4.1. So 3.6 to 4.1, that doesn't sound like a giant number, but when you count how many workers are in the country, we're talking about hundreds of thousands of people now are unemployed. I'm guessing that number is probably 400,000 to 600,000 more people have been unemployed when it's journeyed from 3.6 up to 4.1. And then the other metric too is the job openings. You're seeing, which I always thought this was a huge number, potentially over-exaggerated, but the number of job openings, at one point we're at 11 million job openings in the country. That has shrunk to 8.4 year to date at the end of June. And then here's U.S. Census regions. So this is zooming in a little bit more on the regions of blue is job openings, and then job quits is the yellow orangish color. So we are considered the West. So job openings have dropped 14%, whereas the job quits have dropped 12.8%. Looks like the Northeast, for some reason, seems like the region that's had the best on that category.
That's also a good indicator of how people feel about the economy. If they're not job hopping, they're a little nervous about what's going on with the economy.
Yep. Yeah, coming out of the COVID, we also were dealing with that great resignation period.
Yeah, it was just completely the opposite.
Yeah, so I think more people are just being happy and satisfied and grateful for their current employment for sure. Okay, so here's the real unemployment rate. U3 only counts those who have looked for a job in the last 4 weeks. U6, which is the purple, let's go back. U6 includes underemployed, marginally attached, and discouraged workers. So U6, you can see, is at 7.3. So that could be unemployed, marginally attached, discouraged workers. Gordon, who's your boss?
You.
Okay. Would you consider yourself a discouraged worker?
No, I love my job.
You always tell your boss that. All right. 7.3, 3.9, and then here's the month-to-month basis. Again, 4.1 on the U3, and then U6 up to 7.4% on that. I don't know how they actually get the surveys of discouraged or marginally attached workers, but clearly it's probably going to be a higher number. So annual labor.
It's a Facebook poll. They just do Facebook if you're mad at your boss.
I think it might be higher if it was an anonymous poll. Who knows? Annual labor force participation rate is the number of all employed and unemployed workers divided against the civilian population. So our total population in the United States is what? We're getting close to 400 million, but somewhere around the mid 300 millions. But basically Utah, 69.2% of them are in the labor force. Where out of the country, I think 62.6% out of the United States population. I think part of that is, if I remember right, like Utah has a little bit lower average age, which might have a little less baby boomers or some of that retired population in Utah compared to the United States. Florida, where do people go to retire? Florida, Arizona, maybe Texas. Annual labor force participation rate by age group is the number of all employed and unemployed workers divided against the civilian population. So 25 to 54 is 83.5%. So clearly that's a lot of the workforce. And then you got 38% of 55 and older. Kudos to those 55-year-olds that are already retired. Real wages year over year. So real wages is not only income wage increases, but it's also taking into play inflation. So when you take inflation, even though you got a raise and things are more expensive, it probably doesn't feel like you actually got a raise out there with all the employee-based people. So even 2021, 2022, 2023, wages have been going up systematically, but because inflation, it has basically eroded those wage increases. And even some of these prices, again, you can't go to Five Guys and get a burger, drink, and fries without it being 20 bucks. It has been crazy. A lot of just the normal staple goods on the increase of prices. United States real average hourly earnings month over month. So this is month to month real. This is inflation weighted as well. Here's weekly payroll wages index of all employees. So wages index is the yellow, and then the purple is the index trend line of the increase. So you can see, like, our wages do go up anywhere from 5, 6, 7, 8% a year. This is with not inflation in it, but when you add inflation into it, it basically is flatlined or even slightly gone backwards on average the last 3 years. So the number one thing that's talked about in the news media the last 18 months is inflation. So we're going to go through just a real few categories real quick. This is just the definitions that kind of help separate all these. The first time I did this, Gordon confused me with all the different categories we track, but now he's educated me, so I at least understand some of these differences. But headline is usually what makes the news. Core CPI excludes energy and food. Energy and food just tend to be volatile. A couple, regulations out there could change prices, so they exclude that on one of the stats. Flexible is calculated from a subset of goods and services included in CPI that change price frequently. So it's flexible because some of those products that are included in there change. Sticky comes from the Atlanta Federal Reserve, is based on a bunch of categories that are just harder to move compared to flexible. PPI is measure in change in prices paid to U.S. producers of goods and services. So it's basically the producer's price index, like what people are making things for and selling to those wholesalers. And then the wholesalers send them, to retail. And we'll jump into some of these. So inflation, good news is we have made some progress on inflation, right? Inflation can be one of the worst things for a federal government. But even look at core, which is the teal blue one. It excludes energy and food. Again, we were in the high 6s, 6.4, 6.6%. Them raising rates, some of the things they've done, it has moved the needle on lowering inflation. Last month, we officially hit 3.3% on the core CPI. And again, they'll go back in time and sometimes update these. So these are all updated. And then the CPI that includes energy and food, we got up to 9.1%. They've done a lot of great things, but we got down to 3% on the CPI that includes energy and food. Again, we're trying to get to the 2%. Jerome Powell, the Federal Reserve, they continue to say it doesn't have to be at 2% before they'll actually cut the federal rate. They want it to be trending down, and they want a lot of confidence that we're going to get back to that. So it could be before the 2%. So we still have 1 to 1.3% to go. Here is kind of just the year by year overlapping, where we did. So there's been years where we did get inflation down to 1%. Maybe even close to that 0, but you don't see us going backwards in prices traditionally. Some categories will. Hospital services, Boyd's paying for a few college students right now. Some college textbooks has just been one of the highest categories year over year on price increases. Housing, you can see 88.8%. TVs, toys, software, cell phone services, those are the categories we've actually seen prices lower than where they were a while ago. Here's something we threw in last time, but this is showing you what we talked about earlier of how inflation can be one of our biggest benefits if it's reversed in a 30-year mortgage. So basically, if you went out and bought a property that your annual payment in 1972, your fixed rate 30-year mortgage payment was $1,210 back then. This left column shows the actual inflation all of those years. But when you reverse inflation with a fixed payment over 30 years, you can see how as you make more money, inflation goes up, it actually makes your payment feel less and less and less, which is one of those advantages of our 30-year fixed rate mortgage banking products. But the annual inflation adjusted, that second to the right column, starts out at 1,210, but if you actually reverse that inflation 30 years later, it feels like a $285 in real current dollars 30 years later. So that is an advantage of locking in at an interest rate. Worst case scenario, you just refinance if rates get better, but over a 30-year period, it's going to make it look really good. So here is June 2024 Consumer Price Index broken out in some of those categories. What's happened over the last 12 months. One of the biggest, contributors to inflation being high has been the housing industry, right? Rent's been going up, payments going up, interest rates going up. But with rent now officially year over year down 0.7%, real median home payments only up 6.3%, median price up 4.1%, but you see some of those other categories. So with rent having flatlined or gone down a little bit, that has contributed to inflation going down. But with, higher interest rates, those people that have bought homes, that hasn't helped inflation either. But here's flexible and sticky overlined over the 12-month change. Flexible has been a great category for us. And here's what I was talking about, the producer price index. So manufacturers manufacture things and then they wholesale those prices. What you buy it from Best Buy is not what Best Buy bought that product for from whoever made that TV. So when this goes up, this is one of the things that Gordon mentioned to me. It has been trickling up this year from 1% up to 2.6% is what manufacturers are selling things to those retailers, which those prices just usually get directly passed on to the end consumer. This can be a predictor, a variable predictor of inflation. So that hasn't been working in our favor on future prices that might come out.
And when they've been doing the revisions, they're revising up, not down.
Oh, really?
Yeah.
And then here's real personal consumption expenditures, PCE. This is just like how much stuff are we buying? This is our own personal consumption. I remember Gary Keller 2 years ago when I was in a mastermind, he's like, if we want inflation to go down, you personally have to just stop buying crap and going on vacations. He's like, when you personally feel like you're slowing down your spending, you're going to see inflation, dramatically drop. But the crazy thing is the PCE has still kind of stayed at that inflation target rate. But if it would have just gone backwards, we probably would have saw inflation drop a lot faster. Market-based personal consumption based on, quarter by quarter. We've been trending in the right direction, but still at 2.4 on PCE. And then consumer debt, as, inflation's wiped out some of those raises or income or things have gotten expended, do we actually go and adjust our spending? No, most likely people just go start putting things on credit cards. So we've seen an all-time record high of revolving consumer debt. That is $1.3 trillion of credit card debt. This is consumer revolving debt. So it could be lining credits, but credit cards mainly. And then here is total average debt. It hit the news this week. We officially surpassed $35 trillion of federal debt, which Boyd committed to me yesterday. He's going to make so much money. He's going to personally pay off the federal debt, which is awesome. Thank you, Boyd. Here's the total average. Here is the percent. Thanks for throwing this in there, Gordon. But this is total average public debt as a percent of GDP. So $35 trillion of debt divided by our GDP, we are 122% in debt. So we have more debt than we have total countrywide GDP in a year. And we've been trending up specifically the last 4 years. Some of the spending we did COVID kind of bumped us from 100 to 122. But when you see countries dramatically in challenges, they start getting to that 120, even 150% of their GDP they have in total debt. So whether you're whatever political party you're a part of, for sure our debt needs to be a better priority for our government to kind of bring that down and get more to a balanced budget. Annual personal savings rate of disposable income. So this is the savings rate, which we've seen usually go down When COVID happened, we had less places to go spend our money, so we just kind of catapulted up our savings rate, but it has been trickling down. And then also average deposits. So this is all commercial bank deposits. Is it going up or down? 2022, 2023, you saw savings in banks going down, which also affects the credit availability. So it's even less money that the banks can go out and lend due to their policies. Luckily, at the end of Q2, we've seen this going up. So we've seen more average deposits in commercial banks. And the manufactured durable goods, new orders, that trend line you see is the purple. Still, the last couple of years have been, decently well above that trend line on manufactured durable goods. So we're still manufacturing at great rates. Purchasing managers index, kind of just these retailers always have to purchase way in advance to predict our consumer spending habits. But we've been kind of right at that trend line, but we have been less over the last 2 years, right below that trend line. Overall, you can see Gordon, this is one of his super science things from his previous career, but mainly I look at this direction. So out of all these things, employment, production, new manufacturing, new orders, inventory, customer inventories, prices, backlogs, all those things, are we contracting or are we growing? Even though the economy is growing, a lot of those categories have been contracting manufacturing-wise. Any comments on that, Gordon? Okay. Advanced retail sales, you can see we kind of covered that, up 1.8%. Consumer sentiment. So this is kind of just a survey of how consumers are feeling, but the trend line right there is that teal blue, yellow is US, purple is Utah. So Utah shrunk a little bit, but we've already surpassed that trend line again. So I think we have a little bit more optimistic view of the market. Here's month by month. Utah outpacing the United States on that. But it's better than we were in 2022, looks like, right? Unemployment and inflation combined gives us what they call the misery index. As inflation's going up or unemployment's really high, this is going to be a higher misery index. But we officially from 2022, because either inflation's come down, we've got a little bit more acclimated to the market, but we are below that trend line, but we're a 7 on that number. Lower number is better. Month by month. Oof. All right. Anything on the U.S. Before we're hearing go compare it to the Utah economy real quick? Okay. May 2024, you can kind of just see the industries where we have had job growth, construction, manufacturing here in Utah, health services, government. This is what we talked about, Gordon, a lot of government jobs, health services have been in the country, kind of what's held our unemployment together. Main Street, a lot of just normal, tech job, business jobs, those have gone down. So if it wasn't for government jobs and even healthcare jobs, maybe academic jobs, it's averaged out to still unemployment being good. Skip a few of these, but here's Utah unemployment, 2.85%, still well below the United States, but we have trickled up almost the same ratio, up a little bit, 0.3 on that. Month to month, again, we're at 3, kind of following that trend line of the United States, which is the purple line. Domestic product increase, again, that's old 2023. But here's Utah GDP. We have just systematically grown our GDP, because our economy is great, but we also have more population, which contributes to a higher GDP. Year over year, Utah, we are at 2.5% on GDP. And the personal income growth, Utah has been outpacing the United States on income growth the last, maybe 8 quarters, 9 quarters in a row. And let's try and hit construction. So new U.S. single-family home starts. So this is the number of homes started. We want to be at that million home starts every year. We were there the last couple of years. 2023, we slightly fell below that number, but we have been 14 years below that million average, which signifies that underbuilt status. The orange yellow is single-family building permits, and then total permits is purple. So this is all permits pulled. We've been trending backwards for the last 3 years on permits pulled, as you can see. As costs, the cost of money, all that's worked against us. Single-family building permits, housing starts is the yellow, purple is the total permits. But we're down 35% on single-family permit change. Dropped quite a bit from 22 to 23. And then U.S. price index of single-family homes under construction. You can see, you've seen those price increases there. Builder confidence, seeing some positives. Last year was the lowest we've been in a while, but trickled up so far year to date 2024 on builder confidence. We want to be above that 50 number on the trend line. So if you look at month to month, we were there at the beginning of the year at 51, but as of June and July, we are below that number, 43 and 42 on builder confidence, which is just, it's hard to build something and make money right now, right? Under a lot of the current circumstances. So total debt, you can kind of see the composite debt, just more debt the last 10 years, almost another $10 trillion of debt. Mortgage originations by credit score. Green heyday was 2020, 2021. A lot of those high credit scores were just refinancing or originating a lot of loans. Here is by credit score of your auto loan originations. And then total debt balance by delinquency status. So red is severely late, above the 120 days. Green, the lowest is 30 days late. But still right around that 3 to 4% of total debt in delinquency, which is still record lows, which is positive for us. And then a lot of regulation, which has moved that student loan number kind of just flatlined because they kind of just paused all student loan debt with, Biden trying to write off some student loan debt. But credit card, you see credit cards where the delinquencies really climbed the last couple quarters. Above 10, 12% delinquent credit cards over 90 days. Number of consumers in foreclosure bankruptcies still lows. Third-party collections still really low. Once it's deemed non-collectible, they turn it over to collections. All right, let's stop sharing. Boyd, wrapping this up, any last final tips or value points you want to mention?
Yeah, that's a lot of information. Thank you, Johnny, and Gordon for making this available to us. I think, for the agents, just grab a couple of these that you think are relevant that you can use in your presentations. And if you need help understanding them better or how you'd use them in your presentations, get with your team leader or Johnny or me or something. I think it's really good information. And I guess being an old head, the things I think about is there's 100 and some slides there, and there's 2 circles. And one is a circle of the things we control, and that's pretty small. And the rest is all in that big bubble of things we don't control. And, what we control is our mindset, our activities, and our perspective on these things, and that'll propel us. I also took all of your data, and like the kids do, I fed it into ChatGPT for the AI analysis, Johnny. And what it came out on is that if we want to decrease the misery index for all of us real estate agents and increase our personal economic outlook, the prescription is take 5 listings in the next 30 days. It'll be 100% guaranteed that your personal economy will be trending upward and your misery index will be trending downward.
Totally true. Listings are going up. We should be taking our unfair share, and that will solve a lot of problems out there for sure. Great advice. Gordon, any last comments? Nope. Okay. Well, thank you for all being on. We'll see you next quarter. And again, kwutah.com. You can go find these PDFs under the agent resources. You're welcome to use them as much as you want with any of your clients. kwutah.tv, just if you want to go rewatch some of this. So you could pour over this several times. A lot of data in there, but thank you for being on. Happy week, and let's look forward to August. See you, everybody. Thanks for being on the call.
Thanks, guys. See you.